we're transitioning into an environment that maybe looks a little bit more like the 30 years between the mid-60s and the mid-90s. I've been calling it the temperamental era. And it was an era of more inflation volatility. That's not the same thing as saying inflation is high and going to stay high, just more swings in inflation. A global economy that is more subjected to maybe supply shocks, not just demand shocks. It's not an environment without opportunity for investors. It's just a different environment than I think what a lot of investors got used to for the past 25 years or so.
Liz Ann Sonders, Chief Investment Strategist for Charles Schwab, and also co-host of the On Investing podcast alongside Kathy Jones. It is great to see you again, Liz Ann, and it's great to welcome you on my show for the first time. Thank you so much for joining me.
Oh, my pleasure. Thanks for having me. Nice to see you, albeit through the camera.
Exactly. Well, it's great to see you. And Liz Ann, we're at that time of year where outlooks are coming, and I read yours from beginning to end, the one that you put out recently. Incredible read, by the way, and I will link it in the show notes. But I was hoping we could start big picture, where I always start with my guest, to get their assessment of the macro picture, the economy, and the markets. And on the show, you can take as much time as you'd like to set the table, if you will.
Okay, great. So in one of the theses that we've had for quite some time now, probably at least a year, is that this is a unique cycle that has been characterized by rolling recessions. And I sometimes get criticized for using that term, and that's fine. Use whatever term you want to use. But the reality is that's actually what we have seen through this pandemic cycle. Not that anybody wants to relive the last 3.5 years, but if you go back to the point of maximum stimulus that helped launch the economy out of course, what was a very painful but very short-lived recession, all of that stimulus and the demand associated with it was funneled into the goods side of the economy because services were shut down. That was also the breeding ground for the inflation problem with which we're still dealing very much on the goods side, of course, exacerbated by the supply chain problems. Since then, though, many of those goods-oriented categories, housing-related, manufacturing, a lot of consumer-oriented goods that were big beneficiaries of the lockdown phase, have gone into recessions, and in some cases, pretty significant ones. And the same thing has happened within the inflation data. You saw the goods side of inflation metrics go from hyperinflation to disinflation to actual deflation in some categories. But of course, we've had the more recent offsetting strength on the services side of the economy. We've had the later move up in those services-oriented components of inflation metrics. Services as a larger employer, helping to explain the resilience of the labor market. So when I think about recession versus soft landing, which is the perpetual debate, I don't think that picks up on the nuances of this cycle. To me, best case scenario is not so much a soft landing in a traditional sense, because that ship sailed for many of those aforementioned areas. I think it's a continuation of the roll through where assuming services takes a bigger hit than the slight dent we've seen so far, that you've already got some stability, maybe even the start of recovery in some of those areas that already took their hit. More broadly, and this is not just a 2024 story, but I think that this is a period where we seem to be transitioning into, if not already into, just a very different secular environment and backdrop than what existed during the Great Moderation, which most people point that as being from the mid to late 90s up until the pandemic. And I think there's just a lot that is changing. Obviously, we're not in a disinflationary environment like we were in that 25-year period where inflation was coming down pretty much perpetually. Interest rates were coming down. Globalization was kicking into high gear. I think the conditions that existed then, cheap and abundant access to goods and labor, those are all in the rearview mirror. And I think we're transitioning into an environment that maybe looks a little bit more like the 30 years between the mid-60s and the mid-90s. I've been calling it the temperamental era. And it was an era of more inflation volatility. That's not the same thing as saying inflation is high and going to stay high, just more swings in inflation. A global economy that is more subjected to maybe supply shocks, not just demand shocks, not so much deglobalization, but regionalization, friendshoring, supply chain diversification, labor due to demographics more so than things like unions, kind of wielding more power and maybe more larger share of GDP relative to capital or profits. And last thing I'd say is it's not an environment without opportunity for investors. It's just a different environment than I think what a lot of investors got used to for the past 25 years or so.
Yeah. Well, I have to say that's a fascinating frame up for this conversation. A few threads I would like to pull on, and that was interesting, this kind of notion of a new era, not the Great Moderation, but maybe more reminiscent of what you pointed out, the temperamental era. And you said it's not that there aren't opportunities. So I guess my question is, how do asset classes kind of behave with that sort of backdrop, maybe historically, and then maybe where are the sort of opportunities? I would just love to explore that further.
Probably the most stark comparison between the two eras, and that has come into play again, not just stark, but most consistent, has been the relationship between bond yields and stock prices. So for the 30 years between the mid-60s and the mid-90s, almost the entire time, with just a couple of really brief, really minor exceptions, the correlation between bond yields and stock prices was negative. And that's, and I have a chart in the Outlook that shows this. It's on a rolling 1-year basis. That doesn't mean every single trading day or every week they have that inverse relationship. But if you look long term and you look on a rolling 1-year basis, consistently an inverse relationship. The complete opposite occurred for most of the Great Moderation era, with a brief exception in 2008. And the reason why you saw such stark difference in that relationship was because the mid-60s to mid-90s had more of an inflationary backdrop. There was more inflation volatility. So for instance, during that era, as an example, if 10-year yields were moving up, particularly if they were moving up sharply, it was often because inflation had reignited. Again, not a great backdrop for the equity market. Conversely, big moves down in yields in that era was often because, whether it was monetary policy or recessions, more frequent recessions, kind of put inflation back in the bag, and that was better for the equity market. Well, fast forward to the Great Moderation era, you didn't have this inflationary backdrop. You didn't have a lot of inflation volatility, which meant that most of the moves in yields had to do with the growth environment without the attendant concerns about inflation. So yields going up because growth is improving dramatically, absent any significant increase in inflation. That's sort of nirvana for the equity market. And of course, vice versa in terms of yields moving down. We're now back firmly into negative correlation territory. It's not so much that I think that will persist, as it's probably the easiest metric or proxy or ratio to look at to judge whether indeed we may be in a new era relative to the Great Moderation. So when people ask me, what are you keeping an eye on to get a sense of whether this truly is the beginning of a new secular environment, that's one of the key things. And it's not without opportunity for investors. It's just a different environment. It really reinforces the idea of, hold to maturity on the fixed income side, so you're not at the mercy of the shorter term price swings. One benefit to having the return of the risk-free rate all tied into this different environment is that there's price discovery again, and fundamentals get reconnected to prices. I think it supports maybe a more level playing field for active management alongside passive management, not over passive management. So those are just some examples of maybe the way to approach investing, particularly while you've got this inverse relationship.
So to be clear, like more active management?
I think active management has not been on a level playing field with passive for quite some time. At Schwab, we've always espoused the benefits of having both active styles and passive styles in your portfolio. So it was never one or the other, but it's been many, many years where it's just been very difficult for active managers to outperform their benchmarks or outperform their passive brethren. And with the return of price discovery and what I think will be an era of greater dispersion in terms of how securities are behaving, it provides an opportunity for active managers to actually kind of do old-fashioned stock picking. I think it's one of the reasons why you've seen the rise in importance and focus of factor-based investing, which has been a big emphasis for us versus the more monolithic, broad index investing or even, monolithic sector investing. I think that more granular invest based on actual characteristics, whether it's growth type characteristics or value type characteristics, or like we've been emphasizing sort of characteristics or factors that have a quality wrapper around them. And I think that's one of the ways to think about the investing backdrop in this changed secular backdrop.
Hey there, I just want to quickly interrupt the video and just say thank you. Thank you so much for coming to this channel and choosing to watch this interview. I hope that you are enjoying it, and I appreciate you visiting the channel. If you like what you see, please hit that subscribe button. It doesn't cost anything. It's totally free, and it will keep you up to date on all of my interviews. I post 2 interviews a week with some of the most incredible people in finance and investing, and your support will help me bring in some more amazing guests. If you already are one of my subscribers, thank you so much. I cannot express to you how much your support means to me. I am incredibly grateful that I get to do something that I'm truly passionate about, and you being there week after week, it not only gives me that energy, but it just gives me that faith to keep going, and it means everything to me. And I love seeing you all in the comments section. I love interacting with you. I love interacting with you on email or social media. I just love hearing from you all, and I just appreciate your support so much. I feel incredibly lucky that I get to do something that I just love. So I just want to say thank you and appreciate you subscribing. All right, back to the interview. Lizanne, I want to bring up the Fed with you as well. And we're recording this ahead of the FOMC this month. And just to kind of get your views there, I take it, I want to hear, are we done with rate hikes at this point? Do you have sort of an outlook if we will see a rate cut? This is like an ongoing conversation.
Yeah, it sure is.
Pretty much every guest on our show has a viewpoint. Would love to hear yours.
I think the Fed is in pause mode. I think unless we get a significant move back up in inflation, which doesn't seem to be in the cards, I think the July rate hike was probably the final rate hike in the cycle. But there's a big difference between pause and pivot. And I think the market expectation that maybe got squashed a bit. As you and I were recording this, it's the jobs day, and we had a much better than expected jobs report. And immediately that took down probabilities for rate cuts at the, and again, we're taping this, but it went from 15% probability of a cut as soon as the January meeting down to low single digits. In terms of the March meeting, that's what really people were honing in on, because you had jumped up to about a 55% probability of a cut in March, and that dropped by about 10 percentage points. So what it shows, number one, is that when you have a Fed that is not providing forward guidance and has stated very firmly for much of this cycle, we are data dependent. It means that the needle is going to move with every data point that comes in. But even prior to the jobs report, the November jobs report released in December, I thought it was premature for the market to be pricing in aggressive cuts starting as soon as March. I couldn't fathom what the conditions, unless on the economic side of the ledger deteriorated significantly, would support an actual pivot to rate cuts, if only for the credibility problems with which the Fed has already been dealing for some time. And they essentially admit that they probably stayed on the zero bound too long and probably stayed in QE mode too long. But it is what it is, and here we are. And this idea that you could start to price in rate cuts with inflation still pretty comfortably above their target, not much more than just cracks in the labor market and an economy humming along. When I've talked to people who say, yeah, I think they're going to start cutting aggressively, I say, assuming some semblance of similarity to the current set of circumstances, how do they talk about a rate cut in that environment? Well, never mind about our inflation target. Never mind that we think there may need to be more of a loosening in the labor market or maybe less wage pressure. We've just decided to cut anyway because real rates have been going higher. And then you add into the mix the month of November being the most significant loosening of financial conditions in a single month in history of those indexes. So to me, what's going to be interesting at the December FOMC meeting, even if it doesn't show up in the statement, is number one, what the dots look like and how Powell addresses the question of rate cuts and market expectations and whether he has to more forcefully push back on those like he has at a few meetings in this cycle.
Mm-hmm. Well, you point out we are recording on Jobs Friday, and we got a better than expected report. We also got consumer sentiment as well. Just want to hear more on your thoughts there. It seems like a lot of folks have been saying, it's great news. Like, how can anybody even be calling for a recession? That's just what I've seen on FinTwit, if you will. What's kind of your read of the data that's come out today?
What's interesting about consumer sentiment put out monthly by the University of Michigan is, as it relates to consumer confidence, the other consumer confidence / sentiment metric that comes out on a monthly basis is consumer confidence has been more resilient in this cycle than consumer sentiment. And that has to do with the nature of the questions that are asked. Consumer confidence tends to gear more off what's going on in the labor market, where consumer sentiment tends to gear off what's going on with inflation, helping to explain why consumer sentiment took a much bigger hit than consumer confidence because inflation was skyrocketing, yet we've had a fairly resilient labor market. So I think the pickup in consumer sentiment this time was also reflected in an improvement in inflation expectations. They came down, and I think that's reflected in consumer sentiment. The only rub as it relates to the part of your question about recession is that both of these metrics have a kind of present situation components and future expectations components. And the spread between the two, in the case of, I think it's consumer confidence, where essentially folks are saying, things are okay right now, but I'm not so sure how good they're going to be 6 months down the road. They might have a different view about inflation on that question than, say, job opportunities, but the spread between the two is actually in recession type territory. I don't think we have passed the expiration date in terms of the long and variable lags, to quote Milton Friedman, as it relates to the aggressive tightening cycle and how it filters into the economy, the inversion of the yield curve, which is incredibly significant, both in terms of magnitude and duration, 19 months consecutive decline in leading indicators. I don't think we can definitively say recession is off the table. As I already said, I think we've had rolling recessions, so the whole thing is a unique cycle. But I'm not sure that any of this data individually or collectively yet completely rules out the idea of a recession, including the jobs report, which if you wanted to nitpick, and that's not my job to nitpick, but you still had problems in terms of multiple job holders and temporary help. You had the striking workers, both in terms of UAW and SAG-AFTRA, come back into the mix. If you exclude those, you were really only about in line with October's job growth, 150 or so. That's still positive, but clearly a significant deceleration. You add into the mix a lot of the increase was government workers and healthcare workers. So, if you wanted to be a Debbie Downer and you were a recessionista, you could find things to point to, even in at least on the surface, a healthier jobs report.
Yeah, I feel like that's been one of the things. It's like the data sometimes has been so murky. You could kind of make a case either way. You could fit your narrative either way.
Incredible cross currents in terms of the data, and not even just one distinct data point might contradict another distinct data point. Even looking inside the details of many of these data points, like a jobs release. There's always sort of something for everybody when you peel a layer or two of the onion back, and it's a tricky. I'm not an economist. I don't forecast any of this stuff. Boy, I'm glad I'm not, because this is a particularly tricky cycle to try to, I think, accurately forecast economic data, especially with all of these cross currents that don't seem to be fading as quickly as we would have hoped.
Mm-hmm. And as you point out, you can't definitively take the recession scenario off the table. Right. I want to hear more on the yield curve and the relationship there. Maybe just more for the audience. It gets brought up quite a bit, but you had a section on it in your outlook. Just want to hear how you're thinking about that. And I think in the past, it's historically kind of indicated that there will be a recession. We haven't seen it yet.
It's been a near perfect sort of predictor, so to speak, of recessions. There was a very, very brief, very, very mild inversion, literally for a blink of an eye, and I think it was 1998, and it wasn't sort of not immediately followed, but it wasn't followed within the typical range by a recession. Of course, the next recession wasn't until 2001, but leaving that really brief and mild inversion aside, for the last 6 decades, every inversion has been followed by recession. The rub, though, is, and this is where I find that I get somewhat frustrated, or I'll find myself shaking my head if I see a headline or hear somebody say, whether they use the word average or typical. The average span is, and it is 11 months from the initial inversion to when ultimately we find, which is also way down the road, that a recession has started. We can, neatly look at this stuff after the fact, but we also have to remember how things are declared and how they unfold. But in terms of that average of 11 months, the range is 3 months to 21 months. And you don't have a huge sample size when you're talking about an inverted yield curve. So by definition, when you have a very small sample size and a really huge range, the average is almost irrelevant. And you most certainly should never use the word typical, because by definition, with a small sample size and a wide range, is none of the individual outcomes actually resembles the average. And the same thing could be said about the 19-month decline in the LEI. We have seen a wide range in terms of the time span to recession. Market performance has varied quite dramatically. And then the last one that we point out in the outlook on that subject of small sample size, wide range, is when the Fed has stopped hiking, the final hike in the cycle. How does the market do 6 months later, 12 months later? And again, I always see these headlines, the typical behavior or the average behavior. Yes, you can draw an average. It's easy to do. But 6 months after the final hike, historically, and this covers 14 cycles, the range is from -20 to +20 for the S&P. You go a year out, the range is between -30 and +30. Again, almost by definition, none of the individual 14 circumstances actually resembles at all the average. So it's why in our report, I wrote, I think 3 different times, I don't know who first coined this phrase, but I love it. Analysis of an average can lead to average analysis. And that is at play with the yield curve, with leading indicators, with, the final rate hike. So it's fascinating to think about how people try to simplify it by using, an average or the word typical. And that just doesn't send the right message.
I wrote that line down from the report you mentioned. Yeah, that was a great one. Analysis of an average leads to average analysis. I love that so much. I want to just ask one more question on the report, and then I have a more of a career question for you.
Okay.
And, kind of this notion of being in a new era, seems like the bond market has recognized it, but the equity market has not. Can we explore that a bit further?
Well, I think there's lots of ways to think about it. It's often said that the bond market lives in the real world and the stock market lives in the nominal world. But then there's lots of plays on that in that, bond, traders are a bit more realistic, and maybe, the stock market is more susceptible to, YOLO and FOMO and, HODL and all those fun acronyms that have come back into the lexicon in the last few years. A funny exchange that Kathy and I had, not on our podcast, but during an event, when we heard somebody make the comment about the stock market is almost like a Labrador puppy, just excitable and, always distracted. And I thought I had 3 labs, yellow labs, until 6 months ago. In a 6-month span of time, I lost my 14-year-old and I lost my 12-year-old last November, and then just this past April. So now I'm down to 1. But I thought about Oscar, my older guy, who we said goodbye to at 14. And I thought, boy, he was like the bond market. He had slowed down. He was very observant, very intelligent, knew what was going on relative to, at that time, my 10-month-old puppy, Wilbur, who we still have, who is a maniac. And so I thought, boy, that's a pretty good descriptor maybe of the bond market and the stock market. There's sort of a time horizon difference. There's sort of a calmer approach to assessing the landscape. And I think you're clearly seeing that. And yes, maybe the bond market, with the 10-year having gone from 5% down to 4.1, is sending a message that we're past the most aggressive part of the tightening cycle. But I'm not sure it's yet sending a message that significant loosening is coming. That would happen if you really started to see a sharp steepening in the yield curve. We had a little bit of that, but that has since rolled over. And I think the stock market and the bond market right now are just, you're right, they're a bit disconnected in terms of the embedded economic outlook and Fed policy outlook.
I like that analogy a lot. I was kind of catching up on just your career in preparation for this podcast. I always like to look into my guests and their backgrounds. And you've worked at 2 firms, and you worked for an absolute legend, and that being Marty Zweig.
I sure did.
I was wondering, Lizanne, if you could share some of the lessons you learned from those, I imagine, very formidable years in your career.
It was extraordinarily lucky that I landed where I did right out of college, which was in 1986. And I actually didn't know I wanted to work on Wall Street figuratively. I just knew I wanted to live and work in New York. I had my undergrad was in political science and economics, but I had no idea what I wanted to do with it. I just knew I wanted to live and work in New York. I did a bunch of interviews across the spectrum of industries, had 3 interviews with Zweig Avatar. Did a lot of research on the founders, one of whom was the late, great Marty Zweig, which, by the way, in the mid-'80s, for youngins out there, research had nothing to do with computers or the internet. There was no such thing. I was in the library, literally rolling the crank on the microfiche machine, looking at newspaper articles. But he was well known enough in the business that it was easy to find out a lot of information. He was already a best-selling author. He had mutual funds. He had the most successful investment newsletter ever. So I learned a lot about him, joined the firm, went to grad school at night, and really just became fascinated with the work that he did, which was very much big picture, top-down, understanding how monetary policy influences asset prices, a pioneer in sentiment analysis. He invented the put-call ratio. He coined the phrase, "Don't fight the Fed. The trend is your friend." And I was a bottom-up stock picker throughout that time, and I was much more interested in the top-down. So in 1999, the opportunity presented itself to join U.S. Trust to have more of a top-down role. And less than 10 months later, Schwab acquired U.S. Trust. And as I like to say, I was immediately adopted by the parent company. And they said, "Hey, we want to create this role of chief investment strategist. Any interest?" And I said, "Absolutely." And that was 24 years ago. So
I love it.
I love it.
I have to say, I really enjoyed having you on the show. Liz Ann Sonders, Chief Investment Strategist of Charles Schwab. Thank you so much for being so generous with your time and your ideas. And I hope you have a wonderful holiday season.
Thank you. You do the same. Thanks for having me on, Julia.